Hey, good morning, everyone. Marty Missouri here. It's Friday, April 29th, 2022, with your economic update. As you've noticed, I'm consolidating a couple of things here this morning, and that just has to do with my calendar the next couple of days. This morning, we'll talk about what you see in front of you, our index score, and then we will go through a handful of inputs, and then we'll take a quick technical look at the S&P 500. So folks, this is deteriorating, notably. We had 3 weeks in a row of a score of 13. Now we're down to just under 9, 8.7. Now we have, in the history of our index, as we backtest, we actually officially began right here in July of 2017, but we backtested it a ways. And during the European debt crisis, we got this low. We got all the way down to an 8. And then we came out of that and we had a really good period of economic growth thereafter. Of course, we don't know where we go from here. There's still some daylight between here and what we call recessionary conditions. When we fell below there in August of 2019, we began actively hedging portfolios, and we're sure glad we did, because we mitigated, of course, the lion's share of the COVID decline. And clients, as you know, we're actively hedging once again, so we'll see how things play out going forward. In a lot of ways, this isn't surprising, as we come off of all the juice that was pushed into the economy because of COVID. And of course, there's real market implications here as well. Jumping right in, we got some consumer data. We got consumer savings dropping once again to now 6.2% is the savings ratio. So people are saving less, probably pulling a bit of money out of that $2 trillion in savings they say the consumers have piled up. Consumer spending went up once again last month, rate of change about 1.1%. However, we're seeing fewer mortgage purchase applications here, and that's becoming a pretty consistent trend. Still a pretty hot market when you look at inventory, time on the market, the period that homes are listed. And so forth. So beginning to get mixed signals. I showed you that home builder sentiment last week had declined a bit, although still pretty high on a historical basis. Of course, housing is something to keep a very close watch on here. So folks, as concerning as this picture is about to look, we have to always fold in jobless claims. I mean, we are looking at multi-decade lows. So when employers are hiring and few people are applying for unemployment, that actually says really strong things about the economy. And that's what the Fed keeps talking about, is this hot labor market. That contradicts with these declining overall conditions. So I guess a mixed picture would be the right way to describe it. And inflation. This is ultimately what has everybody concerned right now. So we're looking at a personal consumption's expenditure price index at 6.6. The core, which is what the Fed focuses on, 5.2, which is really high. Is off a little bit from 5.3 the last month, but this does nothing to suggest that the Fed is going to back off of its rhetoric or back off of a 0.5% increase in the Fed funds rate next week. And then the employment cost index, Jerome Powell has been mentioning this of late, and this reflects overall costs of employment. So we know that most employers, employment is their biggest expense, and it's something that ultimately they're going to have to pass through, particularly when consumers are spending money and are willing to pay up for things. So at 4.5, we're talking about the highest level that this index has ever been. Now it's young; it's only about 21, 22 years old. But again, 4.5%, make no mistake, that hugely has the Fed's attention right here. And then last but not least, our quarterly look at Caterpillar global sales. So those are declining as well. Okay, so this gives you a picture of the economy as it relates to the industrial space. Now with infrastructure spending going to start hitting more the next couple of years, that was kind of backloaded. Then we probably will see Caterpillar sales come back up again. But as you can see, it's an important indicator, and it begins to slow down, or it has historically, leading into the past couple of recessions. And worldwide, we're just moving now to just a 3% increase. Of course, we've had some real slowing in China, as we all know, but down 18%. In terms of Caterpillar purchases in Asia, an uptick, nice to see in North America. Now in Latin America, we sales have really cooled off, -1% quarter over quarter. And then Europe, Africa, and Middle East, a 10% increase quarter over quarter. So folks, yeah, we are seeing more deterioration in terms of the growth rate of the economy right here. And that's going to bring on, more talk of stagflation. Rising inflation amid a slowing economy harkens back to the 1970s. And so again, no conclusions here, of course, of yet, but absolutely slowing conditions. We have added to our defensive sectors of late, things like staples, healthcare, utilities. We're inspired to do that based on what we've seen in terms of some of the sector comparisons and then this economic data and so forth. So folks, yeah, as I said before, no time to get cute right here. Huge volatility in the market. Speaking of the market, just because I have it up here, we have the monthly chart. The month's about to end. Today will be the last trading day of the month. And folks, we have right here what you call it another engulfing candle, and that is where the current candle engulfs the high and the low. In this case, the previous two candles. You really get excited about these when they're at the top of an upturn like we saw right here. So this is your engulfing candle as well. Had it here before this 35% decline, had it here before this 20% decline, had it here for a moment, heading into about an 8% decline in 2019. Here so far down about 13% at the bottom, and then another one right here. Not a good look. And of course what I've shown you, and we won't do that this morning, is below this and the momentum is that MACD sell signal, which historically sends us down to the 50-month moving average, which gets us down something like 30% on the year. So stay tuned. Don't like the longer term technical picture right here. Looking at the weekly chart, recall that we have a pattern here that I showed you back a few decades. And it's one where we lose the 50-week moving average and then retest it and then lose it on the retest. Again, virtually every time the last 30 years or so, we went on to test the 200-week moving average, which would put us down in that 30-ish, 35% decline in the overall market. Again, doesn't mean just because it happened consistently over the last 20 or 30 years, and no way means that it's going to happen again. In fact, you might say, well, no, that we're long last we're due for a false signal. I mean, you can make that argument too. Right now, history says when the pattern looks like this, look out below. And then your busy one-year daily chart here. So we had that bear flag pattern that played itself out, almost perfectly. Got to watch out because looks like we could be having another one develop right here. And then, of course, that would take us down, again, back down in here, which would be, something that will definitely get people's attention. Does not look at all unlikely to me right here. Now, we did come back yesterday and close above this real bold resistance line right here. Did bounce around this one. We closed below it, lost it right there, but then yesterday came back and closed just a hair above here. So right now, so far this morning, folks, we're bouncing around between these two right here. Swing traders love this stuff if they can really identify the support and resistance. But yeah, we definitely fulfilled this flag pattern. Again, if you're bullish on the market, you sure don't want to see another one developing right here, because markets tend to flag down in this manner, and we do pretty much have that look right here right now. And then the one that means the least for our purposes, but it's kind of fun to look at, is the 60-day, 60-minute chart. This one we do want to look at these momentum indicators. So remember, we were pointing to yesterday to these bullish divergences, right? We had a lower low and we had the MACD and the RSI diverging higher, and that's bullish, and that did play out. I did say that this was kind of looking like a bear flag right in here. I should bring this down here. And it broke out of that below, and that would take us down to notably lower levels here on the hourly chart. But we caught this, remember yesterday or day before yesterday, we caught this right on the nose, the support level. And look how we battled with this one, and now we're coming off of that. So there's your range right there, folks, right? So any of you want to get fancy and try to day trade this, and I am not recommending that. Today, this would be your support. We fall back down to here. This would be your resistance. You would put a stop loss here, and you put a stop buy there to get yourself out of this in case you lose it. And then you break above that, and then you're going to have some resistance right up in there. If you get a good whopping rally right here. Break down below that, and I'd have to back up and start looking at other levels. So again, just because I know some of you have mentioned that this is kind of interesting to you, I'm not making short-term buy and sell recommendations, but we can get a really good feel for where the momentum is and what probabilities say about hourly moves in the market. And then, of course, everything starts in the short term and then moves up to the long term. And right now, the long-term charts look not good. They look kind of scary. The short-term charts are saying what they should say, and that is they're going to get a lot of volatility, and you can reflect that in here. So folks, the technical picture is not good. The general conditions picture, the economic or the macro picture is very mixed with some real risks out there. So it's a time to hedge against big downside risks and continue to look to add at the margin where value shows up and where we think real long-term opportunities are. So folks, I'll stop rambling there. Thank you, as always, for watching and listening, and hope you have a wonderful weekend. Take care. Bye-bye.